Welcome to TheoTrade. This is Don Kaufman. You are joining me on the afternoon of June 8th, 2016. We still have about 25 minutes to go in the trading day, but our topic of the evening, well, it's going to be a little bit different than maybe we've covered in past events. Number one, the S&Ps today having a rather tight range over here. The volatility not moving that much, but I did a weekend video and just showed a correlation or lack thereof in the weekend video, and it sparked so many emails. I figured I would not only once again explain that, but go into considerably more detail, maybe a little bit of a theory that I've got over here. So let's run with it. So we're not going to look so much at the marketplace necessarily today, but what I would feel is a much longer duration trend kind of developing inside of markets. What you're looking at on the screen right now is the SPX on a 10-year monthly. Yeah, I went for a very broad horizon chart right now, and it is lying right next to the TLT. Now, I felt it most appropriate to use the TLT in this particular circumstance, seeing that some people are not necessarily familiar with the bonds. Now, the age-old relationship that traders have tendency to look for is very frequently what you see is, for example, we'll go back over in the time horizon here of 2007, 2008, and what I'm going to reference, and I'll freeze the screen over here and even draw it for you. Here's the market ultimately descending into the abyss, and at the exact same time as the market descending into the abyss, the bonds are rallying substantially. Now, that was this correlation, or should I call it an inverted correlation, that existed for, quite some time. I mean, really, historically speaking, traders have always looked for that. Anytime there's risk in the markets, what do traders do? They dive into the bond markets because the bonds can be used as a hedge. So again, markets sell off, bonds rally. However, what's occurred, and when you really bring it up on like a 10-year chart, is something, again, you would consider this rather odd. It's not odd. It's the marketplace that we currently live in, and that is S&Ps are pretty much straight up since 2009 with very little, downdrafts in the marketplace. Bonds, quite the same. However, the volatility in the bonds, in many cases, is greater than the volatility over inside of the S&Ps. Okay, the point of this is simply this, all right? The bonds are rallying along with the S&P 500. What does that tell you? Well, the S&P 500 has rallied substantially. The last 18 months has done absolutely nothing. The bonds, however, are right at or very close to all-time highs, which is inversely, if you will, taking interest rates. For those of you that are maybe not really aware of some of the interest rates out there, there's a couple of symbols that you can look up interest rates. One of them happens to be like TNX, okay? That's the 10-year treasury. And this is the interest rate that is associated with, okay, and this is like a 1 year on it. But again, if you want the full view over there, I'll come back over here to the 10-year, because I really think that it does it justice to look at like that 10-year monthly of how low the interest rate associated with the 10-year happens to be. So in this particular case, we're just off, all right, in the last 10 years, the absolute lowest interest rates that we've seen. So herein lies an issue. We have a huge portion of the developed world right now that has gone to negative interest rates. So negative interest rate policy. If you've ever seen, there's acronyms out there, negative interest rate policy, there's zero interest rate, ZERP, NERP, all right? There are all these acronyms for them, okay? What's the issue? The issue is, so right now, if you are looking for returns, or what we're going to call like a risk-adjusted return, which would be considered like alpha, okay? If you're looking for returns in the world right now, where are you going to go? I mean, think about this for a second and forget about maybe yourself. Okay, well, we'll bring your trading as a retail client into this in just a moment. But if you're an institutional money manager, if you are, okay, a bank, or even, a sovereign wealth fund, which is some country that trades, like Saudi Arabia, for example, who just invested, $3 billion in Uber. That isn't even a public company. What I'm getting at with this is, where do you get to put your money to get some alpha out of it? You'd have to look at the S&Ps and think, wow, they're pretty full and they haven't moved up. I mean, we're just a stone's throw off all-time highs over here, and we can hit all-time highs. Then, okay, forget about interest rates for just a second. I mean, interest rates are absolutely rock bottom. This is the 10-year. The 10-year is sitting at like 1.7%. You realize over in Japan, you got to go out 15 years to even get positive interest rates. Okay? You look at the bonds. Clearly, traders have already gone into those bonds. They're buying bonds. Why? Seeking yield. Okay? And if you're not in the U.S., you're bringing your money over from Japan into the U.S. Why? To seek yield here, because you can't get it there. If you're in Europe, what do you got to do? You got to buy U.S. Treasuries. Why do you got to buy U.S. Treasuries? Because you're at zero or negative interest rate policy. Again, in most of the free world right now, they're seeing this negative interest rate policy or near zero interest rate policy. Because of this, okay, the world is sitting, and this is the world of institutional traders, is sitting on this immense mound of capital, and you're viewing it right here. Either the capital's gone into the S&P 500, it's gone into the NASDAQ, it's gone into the bonds over there. You realize today, and one of the reasons I'm bringing this up is today, in Europe, the ECB, it's the European Central Bank, it's Europe's version of the Fed, they just started today buying corporate bonds. And as they buy corporate bonds, what does it do? It brings the price of the bonds higher, which is going to bring the interest rate lower, which is going to make it next to impossible, okay, for traders or investors for that matter to get yield. They're just not going to be able to get good returns, okay, even in corporate bonds out there. So where does the capital go? We have hundreds of billions of dollars right now seeking, okay, and chasing minimal returns in the marketplace. And one of the reasons, and this is where I'll go into a little bit of a theory for you, one of the reasons I think we're seeing incredibly low volatility right now, okay, and it's not often, because I'm going to go out on a limb and I'm going to say this, and it's not often I'm going to say this, but here it comes. I believe that the marketplace, the volatility, if you want to look at the VIX, you want to look at the volatility futures, however you want to gauge volatility, okay, in effect, the volatility is being squeezed away. And I'll actually show you the pressure on the volatility, if you will, and I think looking at the VIX is probably the best way to describe it, although I'm not a big advocate of the VIX. We'll look at it. I think the amount of capital that is seeking returns right now is so substantial that traders are looking for edge anywhere they can get it. I mean, literally anything. I talk to market making firms and they're using 10 times the capital right now to make 1/10 of the return that they were just 5 to 6 years ago. Think about that. They're using 10 times the leverage. So you have all of these trading firms that are levered up, and what it's doing is it's just contracting upon all the bid-offer spreads in the marketplace. It's contracting upon all the volatility in the marketplace. And again, it's not often I'm going to say this. I think the volatility in the market, it's not displaying, okay, the ugly risk that exists in here. Bottom line is, and I've covered this in the past, the risk right now in the market, I believe, is substantially higher than the VIX, okay, or any other option premium is giving it credit for. As such, in the coming days, I'm going to look for and explore how we're going to go out and we're going to buy volatility. And we're going to buy it, okay, with duration. That means we're actually going to get on top of volatility. I want to buy volatility. I want to do it fairly far out in time, because I'm telling you right now, the situation that we're in, okay, could it sustain itself for a period of time? Absolutely. They say don't fight the Fed. why not? It's kind of fun. Okay, but I'm not fighting the Fed in this particular case. The Fed is clearly, okay, disseminating that they're ready to start to raise these interest rates. There is, again, what I would consider substantial risk above and beyond what options are displaying. Therefore, I believe that we'll be able to go into a major index product and we're going to buy duration volatility, okay, looking for volatility to expand, not just in the present, but also in the future. The question is, how am I going to finance that? And that's exactly what I'm going to spend pretty considerable time discussing here at TheoTrade in the next week or so. I mean, this is not something to be kind of taken lightly. Is that, am I looking at the market right now and saying the volatility is wrong? Absolutely not. I mean, the volatility, it is what it is. Again, incredible efficiency. You got to think of volatility like the markets. The analogy I would give you is they're like Amazon. Amazon has gone out and made the world that much more efficient. Like if you want to know what something really costs, go look on Amazon. Hey, it's not always the cheapest, but most of the time, okay, you know exactly what the market is. Well, the market right now, and I'm talking about the actual, market, like in the spiders or any product, there's so many hundreds of billions of dollars chasing, okay, minimal returns out there that it's actually artificially squeezing the volatility. It's squeezing, like, literally the life out of volatility in the marketplace, okay? And in the future, I think that volatility could sustain, like literally an eruption of volatility will come because we often go from one extreme to others. Volatility is like a rubber band, and it's actually stretched right now, okay, to the downside, and again can explode to the upside over there. What strategy we're going to use to employ that is the absolute key. I want to thank everybody for joining us here at TheoTrade on a day-to-day basis. Again, my name is Don Kaufman. Be back on TheoTrade chat tomorrow morning. I'm going to discuss that trade in much more depth. Have a great evening. Bye-bye.